Hey, Steve Saretsky here. As always, a Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value entertainment out of these videos, all I ask that you hit thumbs up, subscribe. I appreciate the support. As always, if you have any comments, put those below and we'll banter back and forth. The whole process of this show is basically to recap what's happening in real estate, Canadian economy, how this all ties together every single week. I will bring you things that basically are of importance that you should probably be following. And so this week it might get a little bit more technical, a little bit more confusing. I'm going to try to slow it down and analyze it so everybody can make sense of it. But as I have mentioned, there's a huge importance to watch monetary policy, what the Bank of Canada is doing, how that impacts interest rates, which again is really the cost of borrowing money, and everybody is borrowing money in real estate. So really the impacts of that is substantial. And as I've said for really in most of my videos, is that over the past decade, even longer than that, there's been a huge dependence on the Canadian economy to drive growth from the household, household spending, households taking on more and more debt, ultimately funneling that into real estate and driving prices higher. Higher real estate prices tends to drive consumer growth to a certain extent. But as debt reaches the egregious levels that it is at right now, and as house prices get to the prices that there are, eventually this policy becomes equivalent to pushing on a string, where there's only so much households can really take on and borrow before it ultimately becomes a drag on the economy. And so the shift more recently from not only the Bank of Canada, but the federal government, provincial governments, to really slow down real estate, to slow down the growth of household debt, has been very obvious. And it's been, quite honestly, it's been written up in the Bank of Canada's public statements. All you have to do is go there and read them. And so more recently, there's been a decisive action from really all levels of these people to slow down these markets, where you have two stress tests coming in. You have the Bank of Canada hiking interest rates several times. You have provincial governments introducing foreign buyers taxes, speculation taxes, etc., etc. So this is all designed to sort of slow that, and so Bank of Canada is aware of this, and so is the federal government. So they've actually increased their fiscal spending. They're going to then sort of basically pass the torch. Households are going to pass the torch to the federal government, and they're going to drive economic growth through that engine. But just watching what the Bank of Canada has been saying recently, they actually came out and said, yes, we're thankful that the federal government is actually stepping up to the plate. Households simply can't afford to borrow anymore. And Poloz recently said that households are actually 50% more prone to shocks to interest rate hikes because of the elevated levels of household debt. So the Bank of Canada wants to hike interest rates. They need to hike interest rates to get out of this ultra low interest rate environment. But again, when your household debt is so high, they're really basically backed into the corner and they can't do that. Just by hiking interest rates 2 times in 2017, Canadians paid an additional 9% in interest payments. And so that's kind of where they're at. And basically what they've come out and said was, Poloz basically said, I don't even know where interest rates are going to go. We're very data dependent. We're continuing to watch it. So speaking of data dependent, headline inflation recently in Canada for the month of February hit 2.2% on a year-over-year basis. So that, I believe, that was the highest since 2012. And so what that important is because the Bank of Canada actually has a 2% mandated inflation target. So their whole basically objective and goal is to hit a 2% inflation target. As soon as they start to get over that, they basically have to hike interest rates. Now, that doesn't necessarily mean because we've hit 2.2 that they're instantly going to hike next time, but this is a very important data set that they will be obviously watching to see if this is just a temporary increase in inflation or if this is going to start to potentially take off. And this is really a result of a lower, weaker Canadian dollar. As you have national home sales decreasing by 17% on a year-over-year basis, you have weaker GDP growth in the fourth quarter of 2017. First quarter of 2018, GDP is expected to come in at a very weak 1.4%. So global investors are looking at this and saying, well, I don't want to invest in the Canadian dollar. That's pushing our Canadian dollar down as the Federal Reserve in the United States hikes their interest rates as they did last week. That puts further pressure downwards on the Canadian dollar. So you can see we're starting to report some inflation. So this will be very important to watch moving forward. So just speaking of that, that's how that all sort of ties in together. Now I really want to touch on, again, from a global perspective, the desire from regulators to curb and mitigate the risks of slowing real estate market as they are putting out these policies to slow the market. They are also simultaneously hoping to mitigate their exposure, or the Canadian taxpayers' exposure. So that comes in the form of CMHC, insured mortgages. So the whole point of the stress test is basically get, people away from the big banks and towards smaller lenders. That's ultimately how I see it. And you can see that in the recent numbers. So uninsured mortgages recently jumped. They now make up 53% of all Canadian mortgages. They have now surpassed insured mortgages, and that stems not only from the policy change of the stress test, but this is more of a later cycle thing where you start to see growth in the mortgage broker channel as people have to get more creative for financing to afford higher real estate prices. I mean, obviously, if you're going and trying to sort of leverage yourself into a home that potentially you can't afford, or maybe you can, but you simply don't, you just need to get a little bit creative. Really, a big bank isn't going to do that. It's going to be an individual mortgage broker who's going to work really hard for you, who's on a commission, that is, works to build up his own client book or client base. They're going to get a little bit more creative. And so that's how you can see that growth in the mortgage broker channel as well. But this really all stems, again, looking at CMHC and their desire to mitigate their exposure to the market. What they have is called CMHC has, and nobody talks about this, right? Everybody just wants to talk about shortage of supply or population growth, etc. But nobody wants to talk about CMHC's involvement because quite frankly, it's a complicated subject. CMHC insures a whole bunch of mortgages, and they actually have a program called the National Housing Act mortgage-backed securities, where they basically take all these mortgages, they then insure a bunch of them, which is insured by us, the Canadian taxpayers, and then they package that in a bond and they sell it to an investor, a European investor or whatever. And this ultimately provides liquidity to the market because they're basically taking the mortgage, they're insuring it, so they're taking it off the bank's balance sheet, and they're then packaging it in a bond and selling it to someone. And so global investors have been gobbling this stuff up because it's backed by the Canadian government, which is seen as very, very secure. So this provides liquidity to the market. It drives the cost of borrowing for residential mortgages down. But obviously, potentially, as you start to see a slowing housing market, or if you start to see home prices fall, global investors can start to say, maybe I don't want Canadian mortgage-backed security, or if I'm going to buy one, maybe I want a higher yield on that. And so that ultimately starts to translate into higher borrowing costs on a very local level. And so that's sort of how that all ties in together. And as you can see here, this is the total issuance of mortgage-backed securities, the NHA MBS program, which is basically all the mortgages that they have guaranteed and bundled into these covered bonds, basically. And so, yeah, this might be a very simplistic way of saying, but as you can see, they got very, very aggressive in 2000 and 2008, provided liquidity to the market, allowed things to keep moving on forward. and they continue to provide that liquidity. So, but that all stems at the end of the day from outside investors' appetite for Canadian debt, and so this again really all ties into the Bank of Canada protecting the Canadian dollar. Obviously, as an outside investor, you're not going to be overly enticed to be investing in a Canadian mortgage-backed security if the value of the Canadian dollar is falling, because then really the underlying value of that bond is also falling. So anyways, I hope that explains it. I'm probably not the best person to explain it. I might miss some technical things, but that's really the grand gist of it, and how liquidity is provided to our mortgage market, which has allowed, just to wrap things up, has allowed BC real estate prices, or has maybe aided in BC real estate prices, Canadian real estate prices. BC real estate prices since bottoming in November of 2008 are up 97%. They actually have peaked as of May 2016. They peaked, and they have yet to surpass that May 2016 peak. That is primarily due to a decrease in detached home sales, as the shift in product has shifted from the detached market, which also peaked in the spring of 2016, peaked and is obviously shifted to condos, is driving up the prices of condos. So even though condo prices are rising, the overall average sale price has yet to surpass May of 2016 levels. But yeah, I thought that was just sort of an interesting tidbit, so we'll continue to watch that. The detached numbers, at least in Vancouver, are looking very weak. But the condo market remains quite strong, so we'll be watching that. But again, that all sort of ties together. The importance of sales. People can talk about sales being weak, but at the end of the day, sales is an important factor into the entire global economy and how all these things connect together. Anyways, I'm not going to ramble on. I know that was probably a little bit more complicated than it needed to be, but if you have any questions, comments, fire those below. I hope this helped, and we'll see you next week.